Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Sometimes the best investments are a little bit hidden for investors, and I wanted to talk about a few hidden investments with somebody who follows a lot of undercovered companies, and that is Lou Whiteman. Lou, how are you doing today?
Good, good. Ironically, it looks like I'm in a bunker, hidden, so it works, right?
It definitely goes with the theme. I like it.
Yes.
Well, we're going to go through 3 stocks here today. I'm going to give you 2 of them. Which one do you want to start with?
Travis, I'm going to start with GXO Logistics. GXO is the ticker. And so let me kind of give you the spiel for this. I'm a big believer in e-commerce, but I am also a big believer that kind of the low-hanging fruit, or if you want to call it, in e-commerce is done. It's a much more complicated world than it was a few years ago. The Targets of the world, the Walmarts have gotten really good at it. It's a multi-channel world and everybody is competing. I own some e-commerce companies, but I sort of think the heyday, the growth days for the e-commerce, the retailers is over. It's just a tough world, just like retail was pre-internet back then. My interest is to find a way to take advantage of what I think is the continuing growth of e-commerce and just the kind of just-in-time, the multi-channel distribution without necessarily putting all the eggs in just picking the right retailer. GXO, for people who don't know, GXO is a company that kind of behind the scenes runs the warehousing, fulfillment, logistics, and very importantly, returns. Returns are a really hard thing to do right. They do that. They do this for big customers. They do it for Apple. They do it for Nike, Walt Disney, Nestle, PepsiCo, Whirlpool. The idea behind this is that with their competency, none of these companies on their own can match Amazon in terms of size and scale of their distribution network. But together, they can kind of have this. And this is, I call this an aspirin stock because the idea is it takes away a headache. Apple built a $6 million distribution facility in Indianapolis and threw the keys at GXO Logistics. Apple doesn't want to be an expert in logistics. They are very happy to give this to someone who is. This is a company right now, it's a $6 or $8 billion run rate, selling into a $130 billion market of outsourced logistics. If you think the way the world is moving is that a lot of these companies that have traditionally done it themselves are going to move to more of at least a hybrid or at least partially outsourced, that could be a $400 billion market. This is a global company. This is, I think, a stealth way to play what I think is a real long-term trend in e-commerce without having to get caught up in which retailer wins.
Would the way to think about this be that instead of vertically integrating, so the interesting thing with e-commerce is like Amazon won the first decade or two because it was vertically integrated. It had the website, it has AWS, it has all the warehouses. But maybe if you were going to start a business today, that doesn't make any sense. And this, one of the successes of Shopify is they said, hey, here's this little niche that we're going to focus on. And then we're going to essentially partner with companies like Facebook to do the advertising piece. And then we're going to partner with other companies to do the logistics piece. They've maybe started to try to vertically integrate a little bit. But I think the distinction here is like for Amazon's very vertically integrated. You're not going to beat them at their own game. And so this happens a lot of times in business. Then you horizontally integrate and you say, I'm going to pick something that I'm really good at and then I can do in multiple places. So now I don't have to just have an Amazon store. I can have a store and I can sell through Amazon. I can sell through any sort of third party. I can sell on YouTube. I can sell anywhere. But GXO is going to handle the logistics piece of it because that's not really my core competency. So is that kind of the right way to think about it? Because I do think that's an interesting trend that we might be moving to.
Yeah, I think you're right. And I think that, I mean, obviously, like most things, there's no one size fits all. Every company is going to look at this differently. Amazon has done an impressive job of building out their logistics. I also think that has been harder than they expected and perhaps not as cost efficient as they had hoped. As you see, they're now scaling back some because they're stuck with these assets. I do think if you are a PepsiCo, if you are an Apple, I mean, Apple of all companies, if someone wanted to throw money at this, they could. But do you really want to get good at this? Or would you rather just work with someone who is good at it and focus on the things you want to focus on? I don't think for a second GXO is going to take the whole market, but I do think this is a growing market and they are an industry leader in a very, very fragmented space with just all the potential in the world to grow, assuming this complex multi-distribution channels assuming it doesn't go away. And I do think I'm not going back to the stores the way I did in the 80s. I don't think anyone is. So I do think this is a pretty safe, just under the radar growth bet.
Yeah, market cap of $6.2 billion as we're recording, PE ratio of 29. So if they can grow into this and expand margins, that could be a really good one. But one I want to go.
Oh, yeah, sorry, just one real quick one. One interesting thing about this company right now is a good bit of their business is in Europe. And Europe has had a hard time also with the strong dollar. They have had trouble with exchange rates. So if anything, I think that it's underappreciated right now if you have a long-term mindset. I do think some of this cash, I think they're going to put it to work and maybe with M&A expand in the US to kind of balance that out. But for right now, you are getting kind of a skewed picture of this business just because of the Forex.
Yeah, I like that one. I'm going to go with a name that you probably know, but for a reason that you might not. And that is General Motors. Just to give some baseline numbers here, price to earnings ratio of 6. Yes, 6, a 1% dividend yield. But I don't particularly care about General Motors, the auto manufacturer. And that may sound a little bit crazy, but the reason that I like this stock is they're about 80% ownership of the autonomous driving company Cruise. When I think about the future of autonomous driving, I don't think it's us spending $15,000 for software that will drive our car for us. Personally, think that's kind of crazy. If I'm going to spend $60,000, $80,000 on a car that has incredible performance, I want to drive it. I want to be behind the wheel in control of that vehicle. But if I'm not driving a vehicle, I want to just be a passive passenger. Uber made this market. Before the idea of taking a taxi, it was kind of a pain. It was doable. It was available in a lot of cities. Remember that Uber went from, wow, it's really weird to get into somebody else's car to being something that people use on a daily basis in about 10 years. Autonomous driving today, getting into a vehicle that has no driver, which, by the way, you can do in 3 cities via Cruise, and then Waymo is the other one, the Alphabet subsidiary. You can do that in San Francisco, Austin, and Phoenix today. Take a ride with no driver. That may seem crazy today, but what are we going to think about that 10 years from now? And what is that business going to look like as a result? Think about what Cruise's potential is for profitability. They're basically outsourcing the production of the Cruise Origin vehicle to General Motors. So here again, we talk about business models. General Motors is saying, maybe we shouldn't be making autonomous driving technology and selling it to customers. Why don't we just become a manufacturer for this partner that we own a majority of and is a separate company? And then we can focus on what we do well, which is manufacturing, and they can focus on what they do well, which is building out autonomy in the ride sharing business. I think in the next 10 years, this may be a service that is in over 100 cities, maybe even more than that. I think the costs are going to be significantly lower. Not only are the vehicles purposely built for this, so you don't have to add all kinds of weird things that we have in vehicles these days, because for creature comforts, you don't have to have a steering wheel. You're just building a purpose-built vehicle. They're supposedly designed to run for about 1 million miles. They're electric. They're going to be very low cost. We may get to the point where a autonomous ride-sharing vehicle costs about $1 a mile. That makes it really compelling to maybe get rid of a vehicle and just have one vehicle instead of 2. Or if you live in an urban area, it's not appealing at all to have a vehicle because I can just go get in a Cruise. Maybe there's a couple times a year I need to rent a vehicle or a truck or something like that. But I think this is the future of driving, at least in urban centers. And that's where I think Cruise potentially has a $100 million, $1 trillion business. There's only going to be a handful of companies playing in this market. This is clearly one of the leaders. And so that's why I think GM's actually a good buy, not because of the manufacturing business and the legacy business, but because of Cruise.
So I like this pick. And you and I, we've talked offline on this. You know, I'm a little more skeptical about robotaxis than you are. I see the potential. I'm not going to say it's not possible. It's just I can't wait for the lawyers to get involved. So I don't know. But one of the things I like about this is the boring side of it, that boring automaker, because you are not really putting all your chips on the table of that. I think you would admit that that was the best case scenario you're talking about, however many years out, especially near term, is that we jump in one of these things, cities all over the world. But I mean, at worst, you do have that boring company to fall back on. I will say one interesting thing, and I'm not smart enough to know, but I love the contrast here between GM and Ford. I mean, Ford basically waved a white flag on this. They sold Argo AI and they said, we're just trying to make our cars safer with steering wheels instead. I don't know who's right. And I do
Yeah.
think from the GM side of it, you do get the benefit of whatever incremental advances Cruise makes. You do make your cars safer. So I still don't think I'd want to invest in a standalone Waymo or even a standalone Cruise because I can't see the future. But I
At least
also,
not yet.
right. But I also have no interest in a standalone GM either, just as an auto
Yeah.
manufacturer. Put the two together, and there's a really intriguing, again, under the radar potential there. And so I think it's a really cool pick.
Well, and the one thing that I think kind of gets misunderstood about this, a lot of times legacy companies will see the next thing coming and they'll acquire somebody or they'll develop it themselves and then they'll screw it up. Like Microsoft trying to get into mobile is a perfect example. They weren't able to get out of their own way and get out of the PC mindset and actually rethink what is a mobile phone, what is a smartphone supposed to look like. Apple was able to do that. I think legacy automakers who are just trying to get into autonomy and shove it into their cars are going to end up getting that wrong. Tesla can rethink the way that autonomy should work in vehicles. Maybe they get that part right for personally owned vehicles. What they've done really well with Cruise is literally keep it as a separate company. There is a CEO, there is a board of directors, there is a cap table because GM is not the only owner of Cruise. So there are investors that they have to respond to. That can create some tensions because GM is the majority owner. But I think the fact that they are literally separate companies in a separate city is a good thing from a strategic perspective, and at least allows them to operate on their own a little bit. So we'll see how this plays out. It's definitely not a for sure 100% home run. Like I mentioned early on, you're getting the core business for a very cheap price today. There may be some deterioration in earnings as margins go down during a recession or something like that, but you're getting the core business for cheap. And the upside potential, it's like you're getting a call option on Cruise. So that's why I like this one. What's the last one you want to go through, Lou?
So I'm going really obscure here now, but we said hidden. I'm going for a company called Nelnet, ticker NNI. And this is sort of in a way one of these Berkshire type businesses where there is a lot of operating companies, a lot of things going on. But the one thing I like about Nelnet is that Nelnet is sitting on a huge pile of cash that is a iceberg that is slowly melting cash. Nelnet owns a portfolio of nearly $20 billion in government-backed student loans. That is slowly throwing off cash. The secret sauce here, the way this investment works is their ability to use that cash. I think it's $2 to $3 billion worth of cash just dripping out of that portfolio over the next decade plus. This is a business that puts that cash to work. They've done it in a lot of different ways. Fiber to home is a big thing. That's something another company like Boston Omaha is sort of the same sort of model has done, and they've done it real well, just investing out in that. Once you have that fiber, it is a powerful product. It's hard to replace. Huddle is something that high school athletes all know. Huddle is becoming the leading site for high school athletes to get seen by colleges and to put themselves out there. It's part of a kind of venture capital portfolio that Nelnet has done to put in investments. But the way I found the company is, as a dad of a kid who has been paying private school tuitions for over a decade, years ago, I started looking into something called fax management system, which if anyone's done private schools in this country, they probably know it is basically how schools do tuition collection. It is a mafia business. You have no choice. They sign an agreement with the school. You have to pay that 3% fee to pay your tuition. They put all sorts of products in to help cash management so the school, it becomes sticky for the school. This is just another operating subsidiary inside Nelnet. This is a little $3.5 billion market cap company. People run away from this because they see that $15 billion in debt. A lot of that is because it is a student loan holding company. They also do servicing. There's just a lot of moving parts here where you're kind of betting on management to make good investments with it, but you have a really, really stable government-backed portfolio just generating income and all the opportunities in the world to go put that to work.
Is this the kind of company where over the next 5 years in this down market where there's been a lot of startups, I'm sure, in spaces that would make sense for them, they could potentially go out and buy those for cheap and fuel the next decade of growth? Is that kind of the way to look at the upside?
I think so. Yeah. I mean, definitely the upside is their ability to put cash to work. And arguably, this is a better market to put cash to work than it has been. And one of the real criticisms about this is always because you hear about student loan repayments. And if anything, as
Mm.
an investor, I love the idea of that. I wish that would come because these are government backed loans. You can't wave a wand and make that go away. What that would
Right.
mean is that instead of a slow trickle of cash coming, if we just signed something tomorrow that all the student loans were gone, the government would have to write Nelnet a really big check, and they'd probably have too much cash to put to work at once. But I mean, this is, I think, yes, you are betting on their ability to put cash to work from here. So far, they've done a real good job of it. I like the track record here, but again, this is just let it play out, let it run, and let them do their thing, even though it's a really weird name.
All right. We've got hopefully a few companies to put on your radar if you haven't thought about them before. GXO Logistics, General Motors, but not for the auto company, for Cruise and Nelnet. Let us know what you think about those in the comments section below. Give Riiv Investing a follow here on YouTube, and we'll see you here next time.
Cheers.